All right. What we're going to do is move on to chapter 4. And we're basically going to complete the accounting cycle here. So, completing the accounting cycle, we've gone through basically what the financial statements look like, debits and credits, how to post, how to move them over to their accounts there, and we've also done the adjusting entries. So now we're going to complete the accounting cycle and kind of go through everything that it entails. So let's go through the learning objectives here. So first we're going to describe the flow of accounting information from the unadjusted trial balance into the adjusted trial balance in the financial statements. So how that all works there. Remember we stopped off at the adjusted trial balance. And then you're going to prepare those financial statements for the adjusted account balances, and then prepare the closing entries. We'll talk about closing entries and how that's all done and what that all means. And then we'll describe the accounting process through each of the processes there. In your book, you'll see some good illustrations of that, and I'll kind of point those out as we move through here. So we're going to illustrate the accounting cycle for one period. So walk through it all. Basically what we did in chapters 1, 2, and 3, we're going to put all that together and walk through all of it. And then we're going to explain what is meant by the fiscal year and the natural year. We'll kind of go over that at the end there. Easy stuff there. And then we'll describe and illustrate the working capital and the ratio, current ratio. There's different ratios and different things as we take a look at that. Those are some things that you'll look at in finance, and then also in managerial accounting, you'll look at those also. All right. So all this information here. So basically, this is a spreadsheet of how it all breaks down. You can see some of the information here, and that then feeds into your income statement. We're taking all that information because we don't want to put the income statement together yet if we haven't done some of the things, the adjusting entries that we need, because we were missing some, like wages expense. Remember, we have some of those things there, and supplies expense. So it doesn't give us the accurate information if we put that together before we do all that. So that's why we're doing it afterwards. And so as you can see, how it all flows together, that information here flows into here. So there's your dividends, and then you have your information here, that income statement, and then you have your balance sheet there. And all that flows in from this, goes into here, and from that into your stockholders' equity. So we take earnings into your stockholders' equity there. All right, questions? So that's kind of what we worked on a little bit too on chapter 1 and how it all flowed together. All right, so end of period spreadsheet, worksheet. So this is your adjusted trial balance, these are your adjustments, these are your adjusted trial balance. So that's what you have. So these are the adjustments that we made right here. This is what we had beforehand, this is what we did, and now this is what we're going to have. So adjustments are answered here. There's two possibilities, obviously, and then deferrals and existing balances are changed. And accruals, important information is entered if we have some accruals that we talked about, and we heard some things we haven't posted. And then we take all that information and make sure, and double check to make sure it balances. All right. So revenues and expense balances in the adjusted trial balance columns are extended to the income statement columns after that. So we're taking that over because now we figured out what those adjustments are, and then we're moving it over. And then over towards the balance sheet. We're extended into that. All right. A good example of that, I think I used to have it kind of breaks it down on page 153 for you, a little bit how it all fits together. All right, the income statement for Net Solutions is prepared directly from the income statement or the adjusted trial balance columns of the end of period worksheet. So beginning with fees earned of $16,840. So this is what we have here. We have a rent revenue. So any of the revenues is first. Total revenue is right here. Now, as you can see, right here, this is not really debits and credits right here, as you can see. Okay, just be aware of that. These are debits. This is supposed to be a total credits, but we are just using this to kind of figure things where they are. Okay, so just be aware if you're having a question about this. This should always be a credit, each of these values. All right, so we have 16,960 for my total here, for total revenues, and then these are all my expenses totaling 9,855. And that gives me a net income of 7,105. Questions how that works? And so that information will move to your retained earnings. So now we're going to move that into my retained earnings, which we talked about in chapter 1. So the first item normally presented on the retained earnings statement is the balance for the previous period. So what we started with, whatever we have. Then we add in our net income. We take that in, bring that in, and then we also we take away any dividends that we may have paid out. So because of that, we paid out 4,000 dividends. That means we have an increase in my retained earnings of $3,100, roughly, 3,105. We started with 0, so now my new balance is 3,105. We then take that and move that into the balance sheet. So that's from the income statement. This goes to the balance sheet. Question on how that's flowing? Pretty good. All right. So the balance sheet is prepared directly for the balance sheet or the adjusted trial balance in that spreadsheet we just looked at there. Then you begin with cash, obviously, because we're going to start with our most liquid asset, which is right here, cash, and totaling all these up. These are my current assets. And you can see this is a little different than we looked at in chapter 1. You see things are broken out differently. Right here, you'll see our current assets, which are our short-term assets, and then we have our long-term assets here. So our plant, property, and equipment, we bunch those together. So this plus this gives me my total assets. Over here, we don't have any long-term liabilities, it's all current. So we're just totaling all these current liabilities up, and that gives me my total current liabilities. And then, this is my stock, and this is that retained earnings that came in from the previous. And so that plus that gives me my total stockholders' equity, and this plus this gives me my total liabilities plus total, and my stockholders' equity there. And they should balance. Questions? Everybody see how it's flowing together? Okay? All right. So classified balance sheet is a balance sheet that expands by adding subsections to that, like I said. So that's the current assets that we talked about. There may be the plant, property, equipment, current liabilities, and there may be long-term liabilities. Those are your notes and different things like that. So that's what a classified balance sheet is. So you put it in different categories. We really haven't talked about that a lot yet, but today we'll get it in a little deeper as we move forward. So current assets are anything within a year. Basically, that's what we're looking at. Anything that is expected to be converted into cash or sold within the next year. So that would be considered a current assets. Land and that type of stuff, typically not unless we're planning on moving that quickly. And these are your typical ones here. Oops, back. So cash, accounts receivable, notes receivable. And notes receivable, we'll talk a little bit about what that means, because notes are usually a long-term thing, but there's a portion of that is due within the next year, right? And that's what we're talking about here. And then you have supplies, obviously, we're expecting to use those supplies within a year. So notes receivable are written promises by the customer to pay the amounts of the notes and possible interest at the agreed upon rate. So we made this agreement, you'll pay me this, I will let you borrow this money or whatever it may be for this kind of period here. So that's what note receivable is. Then you have your plant, property, and equipment, which are your fixed assets. And so those are the things that you can depreciate, except for the one we talked about, which is land. Because land doesn't depreciate. We can't depreciate dirt because dirt's going to be there forever, right? You can move it, but we can't really depreciate that. So that's the only thing that is our exception to that. We can't depreciate that one. But the rest we typically can. So equipment, machinery, those type of things, buildings, land, those all fall in that category. Questions on what fixed assets are? All right, current liabilities. So liabilities that are due within a short time, so usually within a year again. So those are the things that are called current liabilities. So all those that we looked at before, within the next year, we're going to be paying those off. And so there's your accounts payable, wages payable, interest payable, and unearned fees. We expect, hopefully, we earn those fees with it. And then obviously your interest payable and all that, same thing. Wages payable really should be only a few weeks in that, typically. All right, questions on current liabilities? All right, so long-term liabilities are more than a year. So think of current, less than a year, long-term is more than a year. That's simple as that. And it goes for both sides of assets and liabilities. So we're only looking at 1 year as our defining line for both of those, long-term and short-term. So those are long-term notes, payable, mortgage payable, bonds payable, those type of things. And you'll go into some of those later. If you are an accounting manager, you'll go into those in your intermediate accounting courses and how you break those down, the bonds payable, and what those all mean. The bonds are basically a note that a lot of times companies provide out there to people to purchase or entities to purchase to basically provide them money for a while, and they pay off, they pay interest over time, and then pay the final at the end. So, you know, your big companies like Disney and those type of companies will provide bonds out there. The higher the rating, usually the more secure it is, the safer it is. Not always the case. Sometimes we don't always know, but because we've had a couple issues with things that happen, like AIG. But for the most part, they are the higher rating means that they're pretty secure. They're pretty strong. The company, they're well backed, and they're looking at a lot is do they have the funds to pay that? Basically, what it comes down to. And so that's how they kind of rate those companies and how they're doing. So you have AAA ratings and other type of ratings there. Then you have your stockholders' equity here, which is the right to the asset of the business. Is presented on the balance sheet below the liability section. So it's the rights that the stockholders have towards the assets there. Okay? All right. So that's capital stock, retained earnings, and those type of things. All right. So we're now going to prepare the closing entries. Now this is where it gets a little tricky in some ways. So we'll kind of walk through this and kind of, because typically I say, you know, you're always going to pretty much have a debit for your expenses, but there's a time and place where we sometimes get rid of those. We'll talk about that in a second here. So accounts that are relatively permanent from year to year are called permanent accounts, or real accounts. So what they are is like your balance sheet information. They're going to continue to move forward, cash. But there's certain accounts that we want to basically zero out. And those are our temporary accounts here. So the amounts, accounts that report amounts for only one period are called temporary accounts. And those are not carried forward because they relate to only one period. And so like our income statement, we want to know how we do each and every period. So we zero those out at the end of it. If we zero them out, then we move them over to retained earnings. And then our income statement, our net income or net loss or whatever we have, and then it goes in the balance sheet. And so we'll take a look at how all that works. So to report amounts for only one period, temporary accounts should have a zero balance at the beginning of the period. So we start off our net income is zero at every single period or month or whatever we're doing. So that way we can see how we are doing each time. To achieve this, revenues and expenses, account balances are transferred to your income summary at the end of the period. So we use a temporary placeholder called the income summary. We'll show you what that looks like in just a moment here. This is how we're closing everything up. So the balance of the income summary, net income or net loss, is then transferred to the retained earnings, which we talked about. So we move that over to that. So we're just going to kind of go through another step in there in between how that, and we'll walk through all that for you. And the balance of the dividends account is also transferred to the retained earnings account. So we transfer all that over to that and figure out how much we have. And these entries transfers are then called closing balances. Closing entries, excuse me. Questions? I'll give you a second to get that down. All right. So there's four little aspects we have to go through, and we'll take a look at this, and it's also in your book. And I'm not quite there yet in your book, but if you do look at Exhibit 5, you'll see how it'll kind of break down. And we'll get to that in a moment here, but I'm on Exhibit 3 here. So in here we have our revenues. They are transferred to the income summary. And then we transfer our expenses to the income summary. And then our net loss or net gain to the retained earnings. and then the dividends. And so we'll kind of walk through this in that order. So I'm going to kind of walk through it with you here. So the income summary is a temporary account and is used during the closing process. That's the only time it's used. So we're just going to use it to kind of shift things around. That's all it's used for. So at the end of the closing process, the income summary account will have a zero balance. We'll zero it out, it'll be done. The closing entries are recorded in the journal and dated on the last day of the accounting period. Okay? So we're just using this as a temporary account to kind of move things to where they need to go. We've just kind of just made them flow there right now. But what we're going to do is we need to close out these accounts. So part of that is here, as you can see, these are all my expenses plus my dividends down here. And then I have my fees earned and my rent revenue, and then my routine earnings accounts. So the first thing we're going to do is debit each revenue account for its balance and credit an income summary for the total revenue. So what we're doing is if we take a revenue account and we debit it, this is my balance. If I debit it, what does it bring me to? Zero. So that's what we're going to have. So what happens is I've taken this to zero now, and then I've taken this one. So what happens here is because I've done this, you'll see my income summary is this, right? Because that's my credits. Because I debited this, and then I credit this. And so the next thing I'm going to do is total up all my expenses here. So all my expenses here, and we'll get the values of that in a second here. So let me slide forward here for you. So that's that. And this one here is your expenses. So these should all total up to that. And then this one here is my retained earnings. Okay, so I'm closing that one out also. So I'm basically zeroing that out, and then finally, my dividends down here. Here's my dividends. And so by the time we're done, this zeroes itself out. These are all zeroed out. These are all zeroed out. And we moved everything to retained earnings. And that's what we are doing here. So we've zeroed everything out, so now when we start the next month, the next period, we are at zero. We're at zero, we're going to start from there. We're going to make money or lose money. And so that's what this whole process is about. So questions on how that's kind of working, I know it's kind of a little hard to see, but we'll kind of go into some of them as we walk through it here. All right, so this is what I was just telling you about in Exhibit 5 in your book, which is on page 158. So this is on 158 here, basically doing what we just saw. So we debit all of those, we can remove all of those and bring those to zero, and we have an income summary here. And then this income summary and this income summary balance out to zero. All my debits and credits zero out. And then all of these, since these are all debits, because they're supposed to be debit balances, if I credit them all, well, for those same amounts, they're now zero. So that's zero, all my revenues, all my expenses are zero. And then I'm moving all my stuff out of my income summary, and then the retained earnings also, my dividends. So we're just checking the steps. 1 revenues, 2 expenses, 3 retained earnings, 4 dividends. All right, questions? Okay, so far? All right, so step 1, step 2, step 3, step 4. So I should have hit that. All right. After the closing entries are posted, all of the temporary accounts have zero balances. So they're all zero, like I just said before. So now if we look at these accounts here, well, these all here, they really haven't been affected because these are all, every one of them are balance sheet accounts. So they have not touched these. So moving forward here, all of these, again, balance sheet accounts. So we have not touched these at all. Again, same thing here. And now, we start here, and now I'm going into my income statement. So these are my revenues. This is all the money that we brought in. I have then debited. I am now at zero. Same here with revenue. Same here with my expenses. Each one of those are now at zero. I basically taken that information, moved it into my retained earnings, and we're starting fresh. So questions on that? And then continue. Oops. And we'll continue on to the other ones, but they can show that. So post-closing trial balances are prepared after that. So you're thinking, all these trial balances, whoa, what we did was double checking everything that we've done. Because we're doing all these things, we want to make sure everything still balances. Because if it doesn't, then we have an issue. So that's what we're going to do is after the post-closing. So post-closing means past the closing point. So we just closed those out, so now we're going to do a post-closing trial balance. And basically get us ready for the next accounting period. All right. So this is checking all of that. Checking all these in here to make sure we balance. Now what you'll notice here is there's no revenue or expense accounts. Why? Because they're zero. All right, so now we're going to describe the accounting cycle and just basically go through everything we've learned in the first 4 chapters, all in the one here. So the accounting cycle here is a process that begins with the analyzing and journalizing transactions and ends with preparing the accounting records for the next period's transactions. Is called the accounting cycle. So there is 10 steps to this, and I told you that when we started here, that we're going to go through the 10 steps of the accounting cycle. So on page 163, Exhibit 8, you'll see that also on Exhibit, actually, it's probably Exhibit 7, I think that's what I'm going to show first. But you'll have, so the first thing we're going to do is the transactions are analyzed and recorded in the journal. So the first thing we do is we put cash into the company at $25,000 that Chris Clark put in or whatever way back when. And so that's the first thing we'll do. And then we'll post them to the ledger. We'll post them to their spots. So we had $25,000 that went to the cash account. Then we will do an unadjusted trial balance is prepared. After all of those have been done, we're going to do that. And then we're going to do an adjustment that are assembled and analyzed there. So we'll take a look at our adjustments that we need to make. You don't have to do this, but it's an optional end of period spreadsheets prepared. So that way you can see how everything is looking and working. So adjusting entries are journalized and then posted to the ledger. So we take that, post it to the ledger after the adjusted entry has been done, and then adjusted trial balance is prepared. Then we get the financial statements are prepared, and after that, we close them out. Remember, we do it after this because we want to show what we have in income and what happened there. So we need our income statements and all that information before we start beginning to prepare to move to the next period or next month. And so finally, then we do a post-closing trial balance to make sure everything is balanced. And so that way we can move forward and we're now ready to go to the next accounting period. So how are we doing? You guys saw how we did all of that? It's starting to make sense. After you do some too, it'll start making even more sense. So this is another visual of that. That's on page 163, what I was just talking about. Basically moving all of these things around. I'll give you a moment to kind of just look at this chart that they have there for you. All right, so now we're going to go through each of those just like I talked about. I went through each step. I'm going to go through every one in kind of a little more detail. So we're going to analyze the recorded transactions, the first thing we're going to do here. After I take a look at this here, so this is your optional spreadsheet, and you prepare the financial statements there from that information we had above. All right, so now we're going to take a look here at the accounting cycle. These are some of the transactions that we did for April. This just stops at the April 14th, but this gives us the information that we've done. So all of this are transactions here. Those transactions are then, after we finish the month here, so we got some more in here. And then just finish that up. All right, so questions so far? Just the basic transactions that we've had. And then what we have is those are posted to the each individual account. And then we have an unadjusted trial balance here. So we have an unadjusted trial balance. You will see some of these are at zero because we'll probably make some adjustments to those. That's what we have them listed there. So those adjustments will then make some of those a little different there. As you can see, a lot of these here are all at zero because we're going to have some of those adjustments. This is the end of period spreadsheet, which is not required, but it makes it a little easier to see how everything was done. So So as you can see here, these are our adjustments that can be made, all in here. Obviously, make an adjustment in one spot, you have to make an adjustment, make a debit, make a credit. So remember that, it ties to something else. All right, so these are adjusting entries. Remember, we went through some of these already. There's 6 of them here. We have the interest expense, $300. We used to opt out the prepaid insurance. And this applies expense and all of those that go into that. So that feeds into it. And then now we have all of those adjustments that have been made. And so now we have our adjusted trial balance. So after we made the adjustments. Then we prepare our financial statements, which is our income statement. We got to prepare this before we zero it out. And then provide that out to everybody. Or whoever needs to get that. So, this is our basic information here. Fees earned, all the expenses, total expenses, net income. And then that information, we have $18,300. That is our net income. That feeds into our retained earnings. We started off, oops, go back here. We started off with 0. We had the 18,300. We have dividends of 6,000. And so that gives me an increase in retained earnings, 12,300. And that is our new balance now. And so next month we will start this. This will be our beginning balance. Next period or whatever we're doing. Okay. That information then feeds into right here. The stockholders' equity. It feeds right into that. And then everything should balance as a part of that. You see here. So these total assets equals my total liabilities and stockholders' equity. And now we're into the closing entries, which we just went over in this chapter. So we have our closing entries here. This is the first thing, our revenues, expenses, retained earnings, dividends. That's the order we go in. Again, my income summary is down. Just a nice one. And then we check our post-closing trial balance. Make sure everything balances. Because we're not, again, those other accounts that we've zeroed out. All right, and then there's our ledgers and stuff. And there's some of the zero accounts we talked about earlier. All right, we're getting close to doing some work. This is the last portion of the chapter, I believe it is. No, actually, there's one more part. I'm sorry. So we have this will be real quick here. So the difference between a fiscal year and a natural year. Obviously, the natural year is basically January to December. That's our calendar year. That's our natural year. Oops. And so the fiscal year can be set up and adopted by whatever they decide to adopt. And so a lot of companies have it in different places. So we'll take, I think we have some examples of those. And then when a business adopts a fiscal year that ends with the business activities that reach the lowest point of operation, basically that's the natural year. I forgot about that. And then you have the calendar year, which is a lot of companies will use the calendar year. Now, sometimes they do this in the natural business year is because it's a lot easier to do everything when things have slowed down. So if you're retail, a lot of times you might just do it right after the Christmas holiday, or you might even do it, you can even do it at the end of March. So because it's pretty slow at that time too. So it's a lot of times easier to do it at that time. And so as you can see, there are so many different ones here. That's when the fiscal year starts. I mean, some of the weird ones right here are like Apple, September 24th. But when they opened the doors and decided that's when we're going to do it. So, and where some of the other ones, this is a little different too. They're different dates, but then you'll see some that have, normal. I mean, even this one's October 31st. That's the end of the third. That's the end of the third quarter usually. So you're starting the fourth quarter for most companies that are on the calendar year. And then Amazon. So there's different ones, different times when they start. All right. So this is some financial history of a business. Basically, the income statement for the year ended. Then you have your income statement the next year, then the next year, then you have your balance sheets there. And so what we do is we try to compare things. So we'll talk a little bit about that when the comparisons made. And that comes up in actually, we talked a little bit about it in the previous chapter, in chapter 3, of comparing how they're doing. And so we take a look at that, and you do that if you go on to In accounting, you'll do that in your advanced financial class where you do comprehensive statements. You'll be taking a look at comparisons and your financial statements and how they do that over a few years. Because when I look at a financial statement, I don't really look at that year. How they done prior to that. So I have some benchmark to compare it against. Now in here, what we're going to take a look at is a few different ratios, and we'll take a look at what they mean. So in here, working capital in the current ratio is the ability to convert assets into cash, is liquidity. Basically, are we able to turn, if we need to, can we basically turn our assets into cash? And so that's being liquid. And then solvency is basically, do we have enough to pay our debts? If we don't, problem. If you're not solvent, people won't lend you money. Because if they lend you money, they anticipate not getting some of it back. And so that's one of the things you have to look at also. So working capital is the excess of the current assets of the business over its current liabilities. So we'll take a look at this here. So net solutions working capital at the end of 2013 is $63.55. As computed, the amount of working capital implies that the net solutions is able to pay its current liabilities. So we're able to pay those liabilities. We have enough cash there to be able to pay if we want to.
So what's the difference between that and
What's that? Basically, it's just comparing our assets and our current liabilities. Retained earnings is that money, the net income that we have made over the time. So what we're retaining towards that. Where here is, I could take some of my cash and pay this off, but maybe I'm holding my cash for other reasons. Because I'm anticipating maybe a purchase, maybe to do some other things there. So we just haven't paid it off yet. And then maybe some of the reasons why we haven't, or we're anticipating needing additional capital to pay other bills or something like that. This could be a lot of different things. So they have 63.55 as part of that. So the current ratio, and when you hear the word ratio, it's usually basically what a ratio would be. So it would be a number over another number. So that's what you're going to be taking a look at. Where here, when you're looking at working capital, it's basically the amount that we have. So when you hear the word ratio, is another means of expressing the relationship between current assets and current liabilities. That's what the current ratio is. So basically, it's assets divided by liabilities. It can be current assets divided by current liabilities. And so if we do that, this gives me a 5.6. This is down by this. Taking that divided by that. It gives me a 5.6, which is rounded there. And that's it, so we can compare. So we may compare businesses. What we want to do, though, is compare businesses that are in the same industry and maybe around the same size. Because if you do different industries, may be different. Coca-Cola may have a lot more current assets and different things like that, or Pepsi, versus maybe Apple. Because they may have more long-term assets and different things like that. So there may be different ones because of different things. Because Pepsi or Coca-Cola, they need to have enough money to be able to pay for all the materials and all the things that they have that they're using all the time. Where Apple may not need as much to do that because they have long periods of time between. All right, so questions? So far, so good? Wow, we've gone through both chapters already. All right. So let's work on a few problems here. So PE 4-02. Page 47.
Oh, 4-2.
Yeah, 4-2A.
Okay.
Sorry. So this is 4-2. And that is on page 188. I'll give you a moment to take a look at that one.